the S&P 500 positioned for a bad decade? Let's talk about what a more defensive environment might mean for your portfolio. To quote the report, stock prices are a function of earnings, interest rates, and risk sentiment. End quote. For the last decade, because of the interest rate environment, growth stocks, so think FANG, have soared because it was cheap to borrow money and make big bets for the future. But in a more defensive environment like the one we're in now, the report points to sectors like healthcare, which, okay, I have some moral qualms with that one, and energy. The idea is that it's time to focus on the, quote, real economy, industrial production, durable goods, aka get your head out of the metaverse's ass and back into real life. One thing that jumped out at me in the report was this emphasis on value segments of the market, as represented by the Russell 1000 value and small cap equities. I asked Christy if she thinks the value premium, which is the overperformance of traditionally undervalued equities, is back.
I would say the tagline for that one, if we're going to boil things down into the simple tagline, is that stocks are mostly expensive. So the higher, overarching theme of what we've looked at is valuations across the entire stock market. So before we slice and dice it into the values versus growth components or the capitalization differences, what we see at kind of the broad stock market level, so looking at the S&P 500 as sort of our benchmark, is that over the last year and a half, we've seen that valuations, and for this we're just looking at price to earnings ratios, valuations have come back down to about the 10-year average, so where they've been. Call that 17, 18 times earnings. But what stands out to us is we don't think we're in an average economic environment. If we're heading into a recession, stocks should be much cheaper than average. So that at the kind of the headline level, they still look pretty expensive, and they don't seem, like a huge opportunity in our mind at current prices. But digging in a little bit more, we do see opportunity within value, and there's a few reasons for that. So yes, I think that value gets a bad rap, especially for the younger generations who haven't actually been alive while it performed well. Part of that is just because value tends to perform well when interest rates are high and rising, and when inflation is high. And we haven't had both of those scenarios for the last 15, 20 years. So yes, value has not been a recent, strong performer, but it has been pretty good this year. So if you think about what types of stocks make up the value side of the equation within a broader index, it tends to give you exposure to sort of the real economy. So these are older, more mature companies. The antithesis of that is thinking about tech, right? And growth stocks. So growth stocks in particular are really, really geared towards or sensitive to the consumer. And where we're starting to see cracks and kind of what signals to us that we might be heading into a recession relatively soon is that we're starting to see cracks in the consumer balance sheet. So I think that all of 2021, what we talked about was that, especially in the US, consumers were in this really great position because they built up a huge amount of savings during COVID. We know there wasn't a whole lot to spend money on. And a lot of people benefited from stimulus checks. So we saw the consumer, in a really good place. Even just in the last couple months, so towards the end here of 2022, we've seen a lot of that draw down. That used to be sort of dry powder that could be put into the stock market and kind of push that higher. But we've seen the savings rate draw down, and we've seen the consumer debt tick up. So if we start to see cracks in the consumer and in terms of how they can spend and sort of personal income as well, those are the types of stocks, growth stocks, that are going to be really hurt by that. So value is a little bit more positioned in terms of where we see strength within the economy. And also it just does look much more reasonably priced. So value stocks look like they're expecting a recession. Growth stocks do not.
So what does this mean for you? If you've listened to our other episodes about diversification, you'll know that we encourage this type of broad diversification all the time. This is mostly because my personal philosophy is that it's better to own a little of everything, but you may already own small cap value or other value tilted equity.